Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question. Is non-direct recognition better than direct recognition? And the answer to that is no, it's not. Anytime you take a policy loan from any life insurance company, the insurer is now earning a different rate of return on those borrowed funds. That's true for any insurance company, and it affects the insurer's general investment account regardless. And that's because all policy loans originate from the insurance company's general investment account. So it doesn't matter what company we're talking about. It doesn't matter where you get the loan from. No insurance company has like this, secret special sauce or whatever. I know there's a lot of like the infinite banking guys. They have this narrative about how direct recognition is better because, don't touch my dividend, hands off my dividend kind of thing. And they're like, I don't want the dividend to change. I want it to be the same. And they have this idea that, if the companies that have this non-direct recognition scheme going on, what they're actually doing is they're the nothing funny is going on, and the policyholder is paying the insurance company and contributing to their general account. So there's no way there's any subsidization going on, and so there's no it is somehow just plain better than the direct recognition type of loan. However, insurance companies, because all of them are lending money from their investment account, they have to choose how to account for these policy loans. And they can do it in basically one of two ways. They can use a non-direct method of recognizing the loan or a direct recognition method. Non-direct recognition means that the insurance company basically ignores the loan activity on the policy when they calculate the year-end dividends. Direct recognition is basically the opposite. They recognize all loan activity on a policyholder's policy and then adjust the dividend on all the cash value in the policy that's being used to secure the outstanding policy loan. And then the dividend on that collateral that's being used for the loan is changed to match the loan rate on borrowed funds. With that said, the difference between direct recognition and non-direct recognition is mostly negligible. There's this idea that, if somehow non-direct recognition, because it doesn't change the dividend payable on a policy, that the insurance company, the policyholder is somehow getting, it's like a magic loan, right? You can take as many loans as you want. You're going to get the same dividend. And that that cost is never being paid for anywhere, right? And what happens in the non-direct recognition is that the company has to account for those costs somewhere. They have to build in a spread somewhere to make that loan work. Otherwise, theoretically, if everybody at the company borrowed them, against their policy, they'd have to figure out how they were going to pay the same dividend. So they'd have to build in a spread somehow to suppress everyone's dividend to make sure that they could continue to afford to, quote unquote, not change the dividend. With a direct recognition, they're directly accounting for the fact that they're lending the money out to the policyholder. So they're saying, if our normal dividend rate is 6% and our loan rate is 5%, well, we just lent you money, right? And instead of earning 6%, now we can only, because the interest rate is 5%, we can only afford to pay 5%. So your dividend on those borrowed funds is now 5%. It also works in the other way. If on the direct recognition side, if the dividend rate is 5%, but the loan rate is 6%, then they change your dividend rate from 5% to 6% on those on the collateral. So it could go either, the dividend rate could either go up or down depending on where dividend rates are and where loan rates are. Hypothetically, well, I'll just say this. A lot of the marketing behind non-directed recognition is essentially smoke and mirrors. For the most part, there is no real advantage to non-direct recognition over the long term. And there might be a disadvantage if interest rates rise or if rates remain very low for long periods of time, and the policyholders are in aggregate are borrowing a large percentage of the GIA, of the general investment account. Hypothetically, there could be a risk if a direct recognition insurer moved like way out of line of its peers and in the wrong direction. But that doesn't really happen among mutual insurance companies as a practical matter. Direct recognition pretty much isolates each policyholder from the loan risks of other policyholders. So one perceived disadvantage to direct recognition, as I sort of mentioned before, is that when the loan rate is lower than the dividend interest rate, the dividend is lowered on part of your cash value. So this naturally slows down the growth of the policy. There is also a potential risk in non-direct recognition policies, because if enough policyholders are borrowing against their policies, the insurance company will be forced into lowering the dividend because they're earning less on their investments. If a lot of people are borrowing, and this has actually happened at insurance companies before, where a large, I won't say which insurance company is, because it doesn't affect the stability of the carrier really, but there's a major mutual company, it was one of the big four, that was starting to see some pressure on their dividend because the number of people borrowing against their policy had risen. It was into the double digits at one point. They had their GIA was starting to, the percent of their GIA that was loan interest from policy loans was starting to grow, and that was just pulling down the dividend that they could afford to pay. So it does affect, if enough policyholders are borrowing on a non-direct recognition, it does start to affect the overall dividend payable to everybody. And even if it's not a big amount, even just the fact that they can do that still means that they have to figure out a way to not change the dividend, which means they essentially non-borrowers have to subsidize borrowers in some way, shape, or form. The IBC guys and some people who will insist that that's not true, but you look at their financials, you ask some of the people that work for the company, that's the way it works. Another risk with non-direct recognition policies is if bond interest rates are falling, it's going to reduce the spread between the policy loan rate and the investment portion of the dividend, which negatively affects the amount of income that you can draw from the policy via policy loans. And which is, I mean, if you bought a life insurance policy a whole life, as to use as future supplemental income in retirement or whatever, you would want to be aware of that. That's something that you just want to keep on your radar. It's something that you have to keep in mind when you're buying this type of policy and you bought it because of the non-direct recognition. That's a risk. It doesn't mean it's going to happen. I'm not saying that it's going to happen. It's just, it is a risk. But I mean, either way, borrowing against your policy can reduce the investment portion of the dividend scale on borrowed funds. On a direct recognition policies, just because that money, as I said before, that money is just no longer available to the insurance company to invest. But in that scenario, they're still paying. The thing about the direct recognition, even though they're going to change the investment portion of the dividend, because there's actually three components to every dividend. People keep forgetting this. Three components. There's the investment component, there's the mortality savings component, and then there's the expense savings component of the dividend. So those three pieces contribute to the whole life dividend. And only the investment component of the dividend is reduced on the direct recognition or increased. It's either increased or reduced. But either way, they're still going to pay the guaranteed rate. So the guaranteed rate, so even when you're borrowing on a direct recognition, they're still paying you the guaranteed rate. So that actually is sort of if there is magic in that would be like the closest thing to being like somehow magical. The insurance company has figured out how to do this so well that they still can afford to pay you the guaranteed rate. What happens with this is, and the investment portion of the dividend rate on borrowed money is then changed to match the loan rate. So if the loan rate is less than the insurance portfolio rate, your dividends will be lower. If the loan rate is higher than the portfolio rate, then the dividends would be increased. And then non-direct recognition companies must also account for the same borrowing costs, but they don't really tell you what they're doing. It's sort of kind of like a black box kind of thing. And really, like I said before, this is accomplished with subsidizing. Essentially, this is just non-borrowers are in some way going to be paying for the people who borrow. But at the end of the day, I think that there's not really that much. If you look long term, if you zoom out long term, there's really not a huge difference between direct recognition and non-direct recognition. Both provisions are not going to, I wouldn't make a decision on a policy based on either direct or non-direct recognition. It's not going to make that big of a difference. It can, one version of that, like one method might be advantageous in the short term in certain scenarios versus another one, or vice versa. Like if interest rates are rising, you might want to have a direct recognition policy. If interest rates are falling, you might want to have a non-direct recognition. Not always, but it could be beneficial for you. There's just different scenarios where one might be better than the other. But over the long term, it all evens out. I wouldn't make a decision based on what method of loan recognition the company uses. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniX.com, and sign up for my daily email list.